Hey everyone, it is Evan here from the Trade Risk on Friday, March 29th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and finish off looking at some sector analysis. So today marks the end of the week, end of the month, end of the first quarter, and we are all going to be inundated with headlines this weekend that says that the major indices all put in one of the best quarters that we've seen in the past about 10 years, I believe it is. S&P 500 up about 13% on the first quarter. Q's up even more, 15 or 16%. Don't have the exact numbers in front of me, but it was a monster quarter, basically recovering all of last quarter's slide, the fourth quarter of 2018, and then some. So when we look here at our market technicals dashboard, you can see green right across the board, nice finish to the week, 5-day change numbers all back in positive territory, and we have basically reclaimed all of the 10, 50, and 200 SMA simple moving averages in the major indices, except for the IWM still below that 200 SMA, but lots of recovery and resumption of uptrend, essentially, to say the least, in all of the major indices throughout the course of this week. When we scroll down and look at the sectors, it's basically the inverse of what we saw last week. We have a nice tilt and skew to the upside now, with transport, biotech, and industrials all leading the charge here on the upside. And on the downside, relative underperformers, utilities, semiconductors, and technology. If we scroll over here and we look at some of the major markets, we have oil, we have China, and we have the S&P 500 all rounding out the top three assets there for major markets. That's a nice risk profile there. And all of that pop that we saw, or most of the pop that we saw last week in the VIX, has come off, along with natural gas and silver right behind. So let's jump into the charts here. S&P 500, this is where we like to start our analysis. This is the weekly time frame, so each bar represents 1 week worth of trading, and this is the cash settled market. So first thing to note is we still have a rising MACD, so we still have rising momentum here on the intermediate, what I consider the intermediate or even long-term time frame. You can see the MACD still inching towards new highs, even though price isn't quite making new highs. It is on a closing basis, but not quite on an intra-week basis. So that's constructive. We've noted that last week, that we still had kind of that path of least resistance, as many would call, to the upside here on the weekly time frame. And when we zoom in and we look at this week's action, you can see we did close a little over 1% higher on the week, 1.10% in the S&P 500. The important point and takeaway here is that we saw no follow through to last week's very spooky sort of outside reversal candle. So if you recall, last Friday, everybody, or it seemingly everybody, was up in arms saying, okay, this is it. The outside reversal, the pullback is coming. Here's the drop we've been waiting for all year. And once again, we are at the point where sellers could not find any follow through to their initial move. A nice sort of shakeout, kind of rattle the cages, no follow through happens, and then the bulls kind of pick up the charge. Now, of course, that can change, right? We're not saying that we should be blind bulls here. There are, of course, always risks and precautions we should be taking. And when we really just sort of look at it over the past 5 weeks, we haven't gone anywhere. So this isn't just a immediate victory for the bulls either. Since the last week of February, we've been essentially clinging on to this 2,800 level like a magnet. We've rallied a little bit above it and we've dropped a little below it, kind of plus or minus 1 or 2%, but we've essentially hovered and moved sideways here with a slight higher tilt grind over the past 5 weeks worth of trading. And that's because this 2,800 level is certainly one to pay attention to. It's one everyone is watching, and for good reasons. It's exactly where the market stalled out multiple times last year in late 2018. It's also where the market kind of found resistance back in February, March of 2018. And of course, we've covered a lot of ground from the lows of December, rallying into a key level. It makes sense that the market would at least hesitate, stall, dance around, and effectively chop up traders at this level. And it's doing a great job at doing that. But as sort of the narrative has been this entire year, the sellers just really have been non-existent. They have not been able to really take a chomp out of this market and move us downward. That will change at some point. Maybe it's next week, maybe it's in 2 weeks, maybe it's at the end of the year. I don't know. But at this time, the sellers still haven't been able to find follow through, and therefore path of least resistance, and buyers still have control over this market. So when we think about levels here on the big time frame, 2872, that's still the upside level I'm paying attention to. Above there, it's essentially all-time highs up around 2940 or so. That's sort of the next two levels to pay attention to for the S&P 500. Big support down at 2600. That's ways away. That's 8-9% away from where we're currently trading. There's some shorter levels before that, but that's kind of the big broad strokes on this weekly time frame. Now, if we go down to the daily chart, we look at things a little bit closer here. This is what sort of the landscape looks like. We can put on some more levels to look at. And essentially last Friday was this day here. This was the spooky day where we dropped, sold off almost 2%. And the narrative, or sort of the thought process we had in our weekend video last week was, okay, this is certainly a short-term, near-term bearish event, but do we get follow through? That was the big question. Is can we actually get some distance below 2800, find some continued selling pressure, and really kind of thrust away from 2800, breaking through some support, and that would give us the much more defensive tone coming into this week. And we just didn't see that. We saw just a mild attempt Monday. It effectively failed. We popped up Tuesday and we chopped around. And again, by no means does that mean that bulls are just in a cakewalk here ready to put on another 13% quarter. It just simply means that support continues to hold, and in the near term, that's what we want to be paying attention to, are these lows looking into next week. If the market starts to take out 2785, that's what I'd be looking at as the danger point in the short term. If we start to take out these lows next week, that's what would put me into cautionary mode. And with the potential window dressing into end of quarter, it's certainly possible. Maybe we get a rug pull right away on Monday. That would certainly change things up, stir the pot, and change the character of the market. But until and if that happens, we do want to just focus on the bigger trend here, and it is even gradual. It is still to the upside here, and we'd be looking at levels to retest, say, last Thursday's highs right around 2855, 2860. That would be the upper level to pay attention to, and then we have that 2872 up there. That's what I'd be paying attention to as well. So S&P 500, kind of a choppy outlook right now, slight edge to the bulls, just given the fact that they did close the week near the highs, and support recently has held. If we start to lose that support, then all bets are off. It's sort of a different environment to pay attention to. So that's really the read there on the S&P 500. Volatility index, like we mentioned at the top of the video, that came down basically, 16%. So didn't quite evaporate all of last week's pop here in the VIX, but certainly pushed it back down to this sub 14 area here. So a little more complacent, a little more subdued as fear kind of comes out of that market. And, one thing we don't look at necessarily with the TC2000 platform, but breadth. Breadth here is something I spend a lot of time looking at. It's one of my favorite gauges of sort of market strength, if you will. And we're seeing essentially just the NYSE, cumulative AD line just continue to make new highs. And we're seeing, even if you look at like high yield, for instance, junk high yield ETF here, this continues to make new highs here. So there seems to be still plenty of liquidity moving here into the upside and supporting the bull thesis. And doesn't mean we should be blind buying everything at these levels, but we do want to respect the trend and not fight it too hard if we're if we have a cautionary sort of thinking. So that is the read there on the S&P. Let's go to the IWM, and this is again another bright spot here, which is the small caps kind of leading the charge this week, putting in a stand. They've been lagging. They've been telegraphing that there's been some weakness here. They've slid a little over 6 or 7% off of those highs. We can see a nice 2.33% turnaround week here, recovering most of last week's sell-off. It's still kind of in this pullback mode here. It's still kind of in this shorter term series of lower lows and lower highs, but it did get a nice kind of bid higher here and nice kind of rotation this week. So we're going to look to see if that can continue next week. Again, the IWM has been sort of the leading market for us over the past many months. So we should still pay attention to this as to see which way this ends up resolving. Does this roll back over and continue in this pattern of lower lows, lower highs, or can we actually take out this prior high here around 156? Something to pay attention to next week. Last but not least is we have the Qs. Qs here, similar to the S&P 500, recovering this week, 0.62%, lagging a bit here. It is holding where it needs to, so it did kind of pull back here, pretty mild pullback as compared to some of the other major indices, but you can see here didn't quite recover, not quite back at those highs just yet. Just a nice kind of close here, a little pop on Friday. We'll see if that can continue next week to retest these prior highs. So far, I think levels are kind of clear here. Wednesday from this week is the lows, 176.60 or so. If we start to take out the lows from this week, next week, then of course, this pullback still maybe has more to go, and we should again kind of same kind of disposition as the S&P 500. If we lose this week's lows, then we do want to be a little more cautious in the short term. So that's the read on the market environment. Let's I know lots of sort of potentially bullish tones here, but I just really want to underscore the fact that no follow-through happened, and really I think chopping is probably the most likely scenario going forward, maybe a slight hint of upward bias. So let us go to some of the other major markets. We'll go to TLT next, which is continuing its march higher as well. You can see on the week 1.27%, nice follow through week to last week's breakout. So last week was the significant week as we started to clear above multi-year range here, this multi-year important level around 123. We broke out to the upside, followed through nicely. It is certainly stretched here. It is certainly extended to the upside, but bulls are getting the job done. We still do have our long position here in TMF, which is the 3X ETF. We've scaled a part of it, and we do have profit targets nearly not too far above where current prices are. So we are kind of scaling out into strength here, but we still have a position looking for this to continue and liking the action that we've seen in TLT breakout. So lots to like there. Short term, it's very tough to chase, but if you have a position, just trail up those stops and manage that risk accordingly. Certainly depends on your time frame. If you go to USO next, you can see USO on the week here was higher, 2.21%, essentially going right back to last week's highs. We pulled back last week, and now we found some support and rallied right back to last week's highs. So the slow grind to the upside continues here in USO. That's constructive for equities. If we started to lose, say, about 12.10, that's where certainly things would get dicey in the short term. Losing this level right here, it was resistance for multiple weeks in February, then it became support now throughout March, and if we continue to hold above there, that's constructive. Lose that level, be a little cautionary there in the short term. Natural gas here, nothing to like. It has just continued to roll over now, getting back towards the year-to-date lows. It lost this 24.50. It continues to slide. I think it's down about 8 days in a row, so it's not an easy short here to pile on, but certainly nothing to like in natural gas. Just continues to look pretty heavy here as it moves back towards year-to-date lows. Last but not least, we have metals. Metals here had an interesting week. It was kind of volatile all around, but mostly to the downside, minus 1.58%, kind of a bearish engulfing week here for GLD. Not the most pretty looking candle here for the bull case. The one constructive note we could say about the bull case is that we are coming back down towards the lows that we made in March. Notice where MACD is. We kind of got a positive momentum divergence brewing here. Does not mean you can blindly buy it, but it does mean that we should be paying attention to these lows to see if they can hold on this retest. That would be a constructive sign. So far, the gap down and immediate sell-off isn't too pretty, so I want to be a little bit careful there. Honestly, it just doesn't have much of an interest to me one way or the other at this time. One could also look at this as sort of saying, we kind of just got a more broadening sort of pattern here, of potential topping pattern. If we're looking at, say, that as a kind of head and shoulders pattern, if you want to call it that, and that's also potential, I suppose, as well. Regardless, 121, no matter how you cut it, is kind of that support level where you want to see it hold. Silver here, kind of same thing. We do have the potential at positive divergence on this momentum oscillator, but as we come down and retest the March lows, but still pretty sloppy, high volume on the breakdown, doesn't really excite me a whole lot. This $14 level is an important level though, because that is the top end. This is the big breakout that we saw at the beginning of this year. If we start to lose that, certainly does not bode well for really, I don't think, metals in either camp if silver starts to break below $14. So that is that covers all of the major markets. Let's get into the sectors here. Let's take a look at what's working. IBB, this was number 1 for the top relative strength performer this week. This was at the bottom of the dog pile for the past, I think, 2 weeks. It came slamming back down into this 107 support, and it held again. So we did find a nice kind of launch pad off of this 107 area, and it did bounce back into the top end of this range. It's very much sideways range bound at this point though. 108, 107 in change, all the way up to about 115. That's the sideways range that we're dancing in right now. Not much to say as we're in the middle of it right here, so tough to take too much of a bold position, but in between support and resistance, let's see which way it ends up resolving. XLI, number 2 on the relative performing list, looks pretty good here. Had a nice pullback, orderly pullback, kind of tried to break down early this, or even Friday, I guess it was, tried to break down back below this pivot low here back from the 11th of March, and we found no follow through. We kind of pushed back up to the top end of this consolidation. So we're looking to see if we get some follow through rotation next week in XLI. Would be constructive here as a potential kind of rotation candidate back up towards these highs. But generally speaking here, I do like sort of the action there in XLI. And XLB also liking this action here as it kind of ran right into perfectly this technical resistance at $56. A couple of times it pulled back, it ran back up to it, it pulled back again, tagged it again, pulled back, and now we're kind of lifting back up here. But notice it's been finding support around $54, so it's still holding up kind of in this range here. I like that as a trader. I like as these ranges compress and it comes back in for another attack at this 56 area. So XLB, XLI, I like both of those into next week. On the downside, SMH here still doesn't look horrible, but it was down negative on the week here. It did pull back kind of abruptly off of this 110 level, trying to find support at 105. So we'll see if buyers can continue to support this here, but could use a little bit more time. It doesn't look as horrible as I think some of these other sectors. XLU, which was top performer, this was leading here last week, did get this pullback off of highs. It's trading just under its all-time highs. The bigger trend is still very much in play there, so really don't have too much else to say about it. And XLK, kind of similar to SMH here, it had this nice run up into 75, very much kind of heated and extended in that move. It pulled back, found some support sort of where it needed to in the very short term, and now it's trying to pop up. So again, kind of need to see where this ends up sticking next week. I wouldn't mind to see just more sideways develop here in XLK and even semiconductors. I think that would just be healthy overall. So that is the market recap for this week. Hopefully you guys made it through the week okay, and as always, thank you so much for tuning in and watching. Another video every Tuesday and Friday. You can subscribe on YouTube or follow us on the Trade Risk, traderisk.com/blog. Have a great weekend, and we'll talk to you next week.